This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call. You're watching us live from the CNBC-TV18 Motilal Oswal studio right here in Mumbai. I'm Sonia and joining me today are Surbhi and Reema. So it's an all-girls team on Bazaar. And guys, it's Friday, so TGIF, right, as we call it.
That's the best cue, Sonia. That's the one that I'm really focusing on. But you know, otherwise as well, I think we're starting off the Friday with slightly better cues than what we had yesterday. And then we had a good pullback in the market, so I think the bulls will.
But you know, yesterday, despite weakish global cues, market showed so much resilience, and we did outperform and close with strength of gains of about 0.7% on the benchmark indices.
Absolutely. So that came out of nowhere, right? It was kind of like a googly that came for the markets, but in a good way. So let's get straight to all the cues that we have this morning. As we were telling you, yesterday was a very good day, but I guess it's prudent to be a bit cautious this morning as well as we head into the last trading day of the week for a couple of reasons. Now, there has been a lot of volatility in the last couple of days if you map it, and there is no clarity on whether yesterday was purely short covering or was it some kind of resumption of a trend. Perhaps you'll get to know that over the next couple of days. Now, there are some big cues that this market is watching out for, and I'll track them very closely. One of them is HDFC Bank. So over the next few days, before the earnings print comes through, HDFC Bank generally gives its quarterly update around the 5th, 6th or 7th. So the market will be watching that very closely. The earnings of HDFC Bank comes out on the 16th of Jan. So in a run-up to that, if the quarterly update is good, then the market will sort of latch on to that, and that could be the next big positive trigger. We also have earnings, tech earnings coming through. You have TCS, Infosys, and then after that you have Wipro, HCL Tech, all back-to-back. So next week is going to be crucial in that sense. But there are a couple of positives for our own markets this morning as well. So you could see some follow-on buying maybe. Brent is down to below $78 a barrel, so that's a big positive. FIs have now, it seems like they've come back after their holidays, so there was large buying that we saw in trade yesterday. More on that later. So today, just purely for today, the GIFT Nifty is suggesting that we could maybe build on to those gains after that big pullback that we saw yesterday. But I would still say it is prudent to be a bit cautious because you don't know whether the uptrend has resumed or not. Maybe it could be all over the place also because, you know, we're getting into a weekend, etc.
Oh, absolutely, Sonia. You're right. I mean, we don't know if there's a, clear defined uptrend that started. But what we do know is that the pattern that we saw in December of FII buying, that pattern continues. I mean, there was a bit of a lull, 1 or 2 sessions. It was just around the New Year's. Yesterday, the way the market moved, it seemed very, very clear that this was a lot of institutional buying, maybe foreign institutional buying, because banks were moving higher. Your FMCG, large cap FMCG stocks, they were moving higher. And the likes of Reliance was also supporting the market. So it was very evident that this looks like solid, strong, large cap buying with the money coming in from the FII fraternity. In fact, just to put the numbers up on the board for you, we had about 1,500 crores of inflow coming in from FIIs, offsetting some of the selling that domestic institutions have been doing to the tune of about 1,400 crores. Now, the thing is that the global setup is still confusing. I mean, we're none the wiser, really. Only thing is that Wall Street last night was a little better off. Yields are still elevated. Even yesterday, we had that move around the 4% mark on the US 10-year. But in terms of the stock action, it was, little better. We had some positivity, some green on US screens. But I think the clearer picture on this will only emerge later tonight once we get the US jobs report, the non-farm payrolls data. So we have to watch out for that. The dollar continues to remain elevated. Around 2-week highs when 104.3, 104.4. Those are the levels that the greenback has been quoting at. So where does that leave us? The sense is that we've had a couple of days of volatility, so maybe this market will want to consolidate. But if something can turn that thesis on its head, it is the sheer power of money. So if we get another 1,000, 2,000, 3,000 crores of FII money, then it's a no-brainer where this market is going. But otherwise, consolidation cannot be ruled out. The next level to watch on the Nifty is going to be the previous all-time high. So the zone of 21,800 to about 21,848, thereabouts, that could be the first hurdle rate for the Nifty to be crossed. In terms of sectoral action, I'll watch out for power stocks today because we have the latest ERC tariff recommendations that have come through. Most of the brokerage notes are saying that it's a fairly balanced approach that the regulator is taking. And in fact, there are some additional SOPs for hydro projects. And we'll discuss that with Vivek as we go along. But the key question for me remains on whether the FII money will keep coming in. And if it comes in, we know what the Bank Nifty will do, and that's what it was doing yesterday. It was providing lots of support for the market. And if that big pillar remains intact, then I think bulls don't have much to worry about.
Absolutely. Let's just quickly round up the global cues then. So yesterday, we had the Dow closing absolutely flat, the S&P 500 slipping about 0.3–0.4%, while the Nasdaq clocked a loss of close to about 0.5%. The Nasdaq has now ended in the red for the 5th consecutive session. Well, the two big news drivers were: one, selling in large cap technology names. You remember the Magnificent Seven, the Mag 7? They're now being called Lag 7. And Apple saw its second downgrade yesterday, the second one in the last 1 week. And the second one was the private jobs data for the month of December, and that was positive. So the US private payrolls data has increased. Americans are hiring. They hired 164,000 people in the month of December, the most since August, and beating forecasts. And that positive jobs data also pushed up the US 10-year yield very close to that 4% mark, 3.98% by close. Today, the focus will be, as Surbhi said, on the December non-farm payroll data. The estimate is about 170,000. Economists are saying you want a number which is not too hot, not too cold. You don't want a number which is so robust that it will trigger perhaps less easing, less rate cuts, but you don't want a number too low, which again raises worry about the US economy and the economy slowing down. The other two indicators, the dollar index we spoke about, it's at 102, 102.5. Brent crude is hovering around Brent crude is about $77.5 per barrel. Two more stocks. We spoke about power stocks. Keep your eye on Dabur, because Dabur's business update says there are early signs of revival in consumption, and this was the big lag trade last year. And finally, the business updates from financials continue to point to strong loan growth. So RBL Bank, 20% loan growth. L&T Finance has clocked in a loan growth of 25%.
Okay, and we're just getting in some data on the number of demat accounts that have been opened in the month of December, and it is so strong. It's actually reached a record high in the month of December. Total number of demat accounts totaled almost 42 lakhs compared to just 27.8. I mean, not just 27.8 lakhs, but if you compare to what we saw last year and last month, it is a big surge in the number of demat accounts. So the equity cult continues, and that's because of a variety of reasons that we've been talking about. Also, some updates coming in from Macrotech, so keep an eye out on that. Realty has definitely been the space to be in. But before we start, let me take you through what's lined up in the first half hour of the show. We'll get you updates from the markets across the globe. Foo Kien Yap of Standard Chartered Bank will be joining in to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At 8:30, we'll do a fundamental stock analysis. Nishchal Maheshwari of Centrum Broking will be with us.
All right, let's kick it off then with the equity call of the morning. Sayan Mukherjee of Nomura says that they are selective and slightly defensive given the run-up in valuations. He says adverse change in the macro narrative can drive a market correction, which will be a buying opportunity. Specifically, he says growth slowdown or US recession can be a clearing event. He says they are overweight financials, particularly banks, healthcare, consumer staples, infrastructure, cement, power, coal and oil and gas, as well as telecom, and are underweight on consumer discretionary, durables and capital goods, defense, metals, internet and IT. Science says they are selective on autos.
All right, let's also get you some views on the money markets. We have a call coming in from Lakshmanan V of Federal Bank, who says that slightly hawkish FOMC minutes weighed on the US 10-year yield and provided the much-needed support to the dollar index. This resulted in all Asian currencies trading lower against the dollar. However, the rupee has outperformed its peers, aided by robust inflows. Thus, he expects the rupee to trade in a range of 82.90 to 83.38 in the upcoming trading sessions.
On the bonds, Lakshmanan says government bond yields were little changed and traded in a thin band as traders refrained from placing aggressive bets in absence of both domestic and global cues. Crude oil prices rose due to supply disruption concerns following the Red Sea attacks. US FOMC minutes failed to provide any major triggers to the market. In the coming session, he expects the 10-year benchmark yield to trade in a range of 7.15 to 7.25%.
All right, well, those are some updates on the equity and bond market. But Fu Keen Yap, who's the senior investment strategist at Standard Chartered Bank, joins us now to tell us what he's made of the entire macro situation. Fu, thanks a lot for joining in. First of all, Happy New Year to you and your entire team at Standard Chartered Bank. Hopefully, this will be a year better than the previous one. Not that the previous one was bad, but what is your own expectation of how things would shape up? Of course, all eyes will be on the rate cutting cycle by the US Fed and back home by the RBI as well. There's the jobs report due later today. But what do you think is front and center on the investors' minds?
Yeah, thanks very much. Happy New Year to you too. So, yeah, I mean, we are entering the year a bit more constructive, especially for the first half of the year. But I think, front and center is still very much as to whether inflation can be controlled and do we get a recession in the US. Now, our expectation is that inflation will come down, and the US CPI print next week is another very important data point. But as inflation comes down, it gives the Fed more flexibility to react and respond via rate cuts. So we think that as inflation comes down, the Fed will have the ability to use rate cuts again to support the economy, and mainly coming through in the second half of the year, and that will be supportive and positive for the US economy. And the question as well about recession and whether that will happen or not. I mean, our traditional indicators of a recession in the US, like your inverted yield curve, leading economic indicators, they're still very much in the camp that there is going to be a US recession. Now, could it be different this time? We will have to watch. But our view is that in the first half of the year, at least, will be okay. That's why we are constructive on equities and bonds. But we are very watchful as to what happens in the second half of the year. But our base case for this year, really, in the US is for a soft landing. What that means is that below trend growth, but still positive. So those are the two main things I would think is to watch: recession and inflation.
Okay, Fook, hi, good to have you on the show, and season's greetings to you. What is the view on India, a market that had a fantastic run in 2023? So we're starting at fairly elevated levels. There's this big debate about valuations. What's your call here?
Yeah, we do like the India equity market. We're constructive on global equities generally, actually, just because of the narrative of a soft landing coming in and rate cut expectations coming in. We think that's actually supportive for equities globally, including in India. What we're seeing now is a bit of consolidation, which is expected. We think there will be a bit of a consolidation led by the tech sector in the US, as you said. But globally, we do like equities. I mean, India equities continue to be very, very strong performers. We think the earnings growth will continue to deliver in the mid-teens earnings growth this year and next year. We've got pre-election spending possibly coming in to be supportive. We think the investor holdings of India equities has been coming up, but it's still low compared to previous years. So we think those are all positive factors for India. They'll support India equities continue to grow. It is a core holding for us, especially on the medium-term outlook.
So India is a core holding in your portfolio. In terms of in Asia, ex-Japan, or in emerging market, what is India's pecking order? And have you increased your weightage on India, or are you likely to do so?
Yeah, we've been having India as a core holding for some time. If you ask me for a pecking order, that's always a difficult question to answer. But within Asia ex-Japan, our preference actually is for Korea at the moment. Korea is a very cyclical market. Last year, we saw earnings dip a lot because of the semiconductor cycle. But we do believe the semiconductor cycle has pretty much bottomed in Q3 of last year, 2023. And that's why, as we expect semiconductors to improve, inventory restocking to happen, they'll be very supportive for Korea. So in terms of pecking order, actually, Korea is our preferred market within Asia ex-Japan because of the reason I mentioned, the semiconductor supporting earnings growth expanding there.
All right, Folk, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts. That's a word coming in on the global markets. Let's take a short break. There's so many business updates that are just trickling in right now. In the last half hour, there's macro tech developers Kalyan Jewelers as well as Equitas Small Finance Bank. So more on that coming up on the other side of the break. Don't go anywhere. Our list of top 10 stocks is lined up.
Well, Asia is mixed this morning. We don't have very clear directional cues, but for the time being, we're going to boil this down to stocks and the top names that you need to watch out for this Friday morning. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, a morning to all of you and happy Friday. Vivek, let me start off with you because we have these, draft tariff norms for the next several years from CERC. How do they look? Good, bad, ugly?
Well, largely overall quite positive. Major overhang goes away. There were worries that there could be cut in ROE, especially as far as transmission is concerned. A slight cut has come through, but, not as far as what the street was anticipating. But let's have a look at the norms that have come in. So first up, these norms will be applicable from FY25 to FY29. These are the draft norms. So most likely, the draft norms will get translated into the final norms, and they will be applicable from April onwards. Now, the first stock on the radar is the NTPC. No change as far as ROE is concerned for past as well as future projects. So that is one positive. Along with that, there is an additional incentive income opportunity that the company will get. So thermal plants generating units of over 85% PLF will now get incentives. Along with that, the O&M, the operation and maintenance escalation, has been revised to 6% from the 4% that was available earlier. So analysts anticipate a 3 to 4% upside to FY24 to FY26 EPS estimates. The second stock is Powergrid, slight negative coming in over there. ROE has been reduced by 50 basis points for incremental projects that come through that will be commissioned after April 2024. A limited impact is expected as most of the additional projects or the new projects that are coming out stream are via the TBCB route. The next stock is NHPC, strong positive over there. ROE remains at 16.5% for existing projects, but has been increased to 17% for new projects. And lastly, NLC India, quite a strong positive. Watch out for this particular name. There could be a strong mover. So what's actually happened is that the TPS2 expansion benchmark has been brought down to 50% from 80% earlier. Basically, this means that the plant availability factor, requirements have been reduced. So that means increased EBITDA for the company. However, keep in mind, newspaper reports yesterday indicated that there could be a government stake sale, as far as NLC is concerned, in order to bring the government shareholding to meet the minimum public shareholding norms.
All right, thanks a lot for that. So important updates there on the power space. But Dabur is also in focus this morning. Mangalam is here to tell us more on that. Mangalam, good morning.
Good morning. So it should come as a bit of a relief to the consumer sector, largely because Dabur says that they've seen early signs of revival in the consumption sector. Rural growth is still lagging urban, so that's a bit of a concern. But overall, for the quarter, they saw mid to high single-digit revenue growth, which was largely volume-led. So if that's the case, then it would be slightly higher than what the street was anticipating, which was low to mid single-digit volume growth itself. Gross margins will continue to expand. They will plow back some of them in ads and marketing. But despite that, the operating margins will also see a slight expansion. How's the business done for them? The food and beverages business usually does the best in third quarter. That's grown in high single digits. Home and personal care has seen about mid-single-digit growth. Healthcare has seen low single-digit growth, largely because the winter has been delayed. And Bazaar, which was acquired by them, has seen strong growth in high 20s itself. The international business expected to register double-digit constant currency growth. So all factors looking like they've improved quarter on quarter, and as a result of which, see some green on Dabur today.
Thank you very much for that. Let's move on now to get an update on RBL Bank and L&T Finance. Abhishek joins in. Abhishek.
Well, Rima, to begin with RBL Bank, the loan growth momentum has been pretty good for them. Deposits are up 13.5% YOY and about 3.3% sequentially. CASA ratio, like peers, it's on a declining trend. And for RBL Bank, it's at 10-quarter low of 33.8% when compared to 35.7% in the previous quarter. Loan growth momentum pretty strong over there, 19.8% growth on a YOY basis and about 4.7% sequentially. So it has helped the CD ratio, which has improved to 88.3% versus 83.6% YOY and about 87.1% sequentially. So one of the rare banks who has seen improvement in CD ratio or credit deposit ratio. Liquidity coverage ratio is at 132% when compared to 142% on a sequential basis. For L&T Finance, only the retail business momentum is given and it's pretty healthy over there. Retail disbursements have grown by 24.9% YOY and about 7.5% sequentially. The retail AUM growth is about 31.1% YOY and about 7.7% sequentially. The disbursals to AUM ratio that has remained healthy at 36.8% when compared to 38% in the previous quarter. In the retail loans, it's been driven by the urban finance, which is up 17.8% YOY and about 10.8% on a sequential basis. So strong retail business momentum for L&T Finance. Back to you.
Okay, all right, got that. Abhishek, thank you very much. Speaking of business updates, we have some from the real estate guys as well. Remember, these stocks were huge movers yesterday. Sonal, tell us more about Sobha and Macrotech.
Well, let me start with Sobha, the biggest mover that we saw in the real estate space yesterday. It was a good quarter for them. In fact, it was the best quarterly sales that the company has reported in Q3. Overall sales value is up 37% to come in at around 1951 crore rupees. Sales volumes up 21%. Their average realization has also gone up by 21.5%. The company says cash flows remain strong in the quarter, and that led to another quarter of debt cut down that they saw as well. So going with green for Sobha this time around. For Macrotech, there has been a growth on a YOY basis, but a decline on a quarter-on-quarter basis. So that would not go well with the street, which is betting a lot on real estate space. Sales was up 12% on a YOY basis, down 4% sequentially. Collections were down 3% on a YOY basis. Net debt was flat on a sequential basis. Of course, a big decline on a YOY basis. The company says they added 3 projects with a gross development value of 6,000 crore rupees. They are on track to deliver their pre-sales guidance of 14,500 crore rupees in FY24, and the business development for 9 months has surpassed what they saw in FY23. So yes, decent numbers, but not as good as what the street is expecting.
Okay, thanks a lot for that. I mean, remember, the stocks have rallied quite a bit, so let's see how it moves today. Perhaps the street preempting some of the good news, especially in names like Sobha. But Kalyan Jewellers has also reported a Q3 business update. Mangalam is here to tell us how it looked. Mangalam, over to you.
Well, you know, irrespective of the sentiment in staples, one thing that is constant is our love for the flashy jewelry and diamonds, because Kalyan Jewellers reported a consolidated revenue growth of over 33% in the third quarter. And this was 33% because the Middle East operations grew at just 6%. The India business for the company grew at 40%, and this on a growth base of 12% itself. So that makes the 2-year CAGR at around 25% itself. That's not all. They added 22 new Kalyan showrooms in the quarter, and they've written letters of intent for about 80 new showrooms in FY25 itself. While it is a positive and a strong update, one also needs to be mindful of the fact that the stock has nearly tripled in the last 12 months. So important to see how much more is the upside for Kalyan Jewellers. But for now, I'm going with green.
Thank you very much for that. Here's a quick recap then of the top stocks. Stocks with positive news flow are NTPC, NHPC, NLC, Dabur, RBL Bank, L&T Finance, Shobha, Kalyan Jewellers. Stocks with negative news flow are Power Grid and Macrotech Developers. Okay, let's get to the brokerage calls of the day. Hormus joins in with that list. Hormus.
Well, you know, earnings season is about to begin, and a lot of reports are coming out on the IT sector. I'll start off with Jefferies on Indian IT, where they've said that the client's focus in FY25 will continue to remain on return on investments, and they expect the firms to intensify cost controls, and that is what will lead to better margins going forward for these companies. The note also says that the demand recovery in calendar year of 2025 will be key to ensure that there is no further PE derating for these companies, and they have upgraded Infosys, Coforge and LTI Mindtree to a buy on strong growth visibility and valuation comfort. Second up is UBS. It has initiated coverage on Hindustan Aeronautics, and it has initiated coverage with a buy rating. The price target of 3,600 implies a potential upside of 23%. And they said that HAL is a credible defense compounder in the making, and it is set to triple its order book by FY26. And also it said that it is on course to re-rate further if it gets its execution right. And lastly, Morgan Stanley on the gas stocks. They said that India's gas stocks offer some of the best growth opportunities as the market goes into an oversupply in the second half. They said that gas players and CGD will benefit alike from volume growth as India's pipeline network doubles going forward. And among the top picks, it has highlighted GAIL, Oil India, Gujarat Gas and ONGC. Back to you.
Hey, thanks a lot, Hormus, for that. Well, another big trigger, positive trigger for our own markets is the fall in crude prices. Brent crude is now below $78 a barrel. Manisha Gupta joins in for a roundup of all the action from the commodity markets overnight. Manisha, good morning.
Morning, Sonia. Thank you for that. So even as we are looking at so many geopolitical tensions, whether it's about the supply disruptions in Middle East, the Israel-Hamas war now spilling over to Lebanon, and oil output halted at a biggest oil field in Syria, the markets are really watching out at the higher crude supplies and inventories around the globe. If you look at the U.S. itself, we are looking at record production. The U.S. gas inventories in this week have gained the most in 30 years at around 237 million barrels right now. The distillate demand in U.S. is the lowest since 1999. I mean, you have these kind of data coming in from Europe and China as well, and that is what is weighing onto the market. Having said that, it is going to be about the non-farm payroll data that could show an increase of 170,000 jobs. This is the number that the street is working with right now. Apart from that, it also is about the dollar index, which has rebounded ahead of the U.S. non-farm payrolls. So all of these seems to be keeping the prices in check, not just for crude, but for metals as well, where precious metals and industrial metals also have started on a weaker note in Asia right now.
Thank you. We'll slip into a break on that note. On the other side, we'll be joined by Nishal Maheshwari, CEO, Institutional Equities and Advisory at Centrum Broking, to talk about individual stocks. Later on, we'll be joined by Amit Mahajan, Director Technical and R&D at Paras Defence and Space Technology, to discuss the company's business outlook. And plus, remember, yesterday we had the Defence Secretary talk about some big spending by the government. We'll find out how it impacts the Indian defence industry. Welcome back. Yesterday, the Defence Secretary, while speaking to CNBC-TV18, said defence production is likely to cross 1.5 lakh crore rupees in FY24. And he added that it may even cross 1.75 lakh crore rupees target. To discuss this and the opportunities, we have Amit Mahajan, Director Technical R&D at Paras Defence and Space Technologies, on the show now. Amit, morning, and thank you for joining in, and greetings of the new year. Defence is now a multi-year story. Paras Defence has been growing well. For FY24, you've set a revenue target of 30%. You are guiding for margins to come in between 28 to 30%. The question is, can you sustain this 30% kind of revenue growth over the medium term? First, your guidance for this year, are you on track? And can you do this in FY25, FY26?
Firstly, good morning for having me on the show. Yes, you are absolutely right. First, also wishing everyone a very happy new year. You are absolutely right. The defense market, defense and space, I would like to tell, is going to do really, really well. Looking at the indigenization policies and Make in India and Atmanirbhar, all the initiatives by the government and the strategies around that, which are driving the indigenous development as well as manufacturing business, this is going to stay here for the next 10-15 years. Now, when it comes to the guidance, unfortunately, I'm in a zone where I cannot put actual figures to it, but I can tell you for sure that we will exhibit strong revenue growth. At the same time, we will also exhibit strong profit growth. This will also continue in the coming years.
But on numbers, Amit?
Unfortunately, I won't be able to mention any numbers right now.
Sure.
Got it, got it. Amit, hi, good morning and thanks for joining in. You know, I was just reading out of an Edelweiss report where they said that India's defense spends currently are $77 billion annually. And out of that, $2 billion is just defense exports. Rest of it is all, indigenous or local, right? So I want to understand from you, is this the extent of the potential over the next couple of years? And for Paras Defence, what is the order book? What's the quantum currently? And what is the opportunity size in terms of orders over the next 1 to 2 years?
So the quantum of order book, I think I mentioned the last time. Unfortunately, like I'm telling you, I can't mention the exact figures. But yes, what you are saying is true. The opportunity size is that big and it is slated to grow bigger than this. The idea is, as you are taking positive indigenization lists one after another, what you are trying to do is we are trying to restrict our imports or our dependencies on foreign companies for the imports part of it. All those companies are encouraged to tie up with companies like us, where if they have to manufacture their technologies in India. At the same time, there is a big thrust given on the development part, where we are doing all complete development all by ourselves. Now, all of this put together, the values that you're talking about, 77 billion, these are values which are, if at all, will be conservative, not aggressive at all. So this would mean a huge opportunity for Indian government, Indian industry, and Paras being a very seasoned player in this particular domain. All the companies who have been in this domain, we have been the Indigenous Design and Development Manufacturing Company, IDDM as they call it, for the last so many decades. Now, all those companies who have been IDDM will benefit largely from these initiatives.
Okay, that's very interesting. You're saying that the $77 billion spends currently annually is on the conservative side, and you're saying that the Indian government could be spending a lot more. Got it. I want to understand overall just two things, right? One is the global arms trade business is around $200 billion currently, and India is just 2% of this market. What is the kind of opportunity that we see over there? And for your own business, right? I mean, what is the sort of trigger for you over the next 1 to 2 years? What's the medium to long-term plan?
Now, when it comes to global arms trade, in fact, for us to be globally ready when it comes to our military forces and the modernization part and the technology part, there is a huge, I would call it, there is a huge opportunity. That's the positive way to look at it. A lot of countries have a much higher defense budget than we do, but we need to up that. We need to secure our borders. We need to make sure that all the citizens are safe. Said that, the opportunity trigger for us is Paras Defense has always been trying to venture into areas which have been niche. We do a lot of research and development in newer areas. If you would have seen 3 to 4 years back or 2 to 3 years back, we ventured into drones when very few companies were there in drones. Today, there are a host of people. We are into anti-drone, again, a zone which is traded by very, very few companies. Now we are getting into quantum communication. So you can imagine Paras always hunts for technologies which are not just analogous and riding on their strengths, but also are cutting edge, not just from the country perspective, but from the global perspective. So that will keep us going on. The research and development will always lead the way and create a niche for us in this technology sector and give value to our customers.
No, absolutely. Amit, just want to understand, you've given a guidance of, as much as 40% growth for FY24. While I know you can't talk much numbers, just tell us which are the segments that are likely to drive this growth for you. Drones, for instance, is smaller, it's newer. What's the scale up there? How much will come from space? And within defense, what will be those niche technologies and products that will drive this 40% growth?
So this year, the space is limited, but you would say about 50% would be coming in from optics and optronic systems, and 50% from defense engineering, which covers defense electronics, electromagnetic pulse, and heavy engineering. So that's the split, almost 50-50%.
And which of the two segments right now is more margin accretive for you, and what's the expected trajectory on margins?
Optics and optronic systems will always lead the margins of the company because they are highly profitable businesses and they will remain to drive the market. We will always continue to put our thrust on these segments so that we keep increasing our profitability.
So confident of margins hitting 30% by the end of this fiscal?
Don't want to put any absolute figures.
Okay, I was just only checking if you're on track with the guidance. I think that's the earlier guidance. Okay, but I guess
we should, yeah.
Okay, good speaking with you. Thank you very much for joining in, and we'll do a deeper chat on the numbers after the quarterly results are out. Well, with that, I guess we move ahead and bring in our next guest on the show, Nishchal Maheshwari, CEO Institutional Equities and Advisory at Centrum Broking, is with us. Nishchal, good morning. Thank you for joining in. Season's greetings to you, and a very, very happy New Year. Since we were just speaking to a space and defense company, let me start with that first. It's really been the sector of 2023, right? And then you had those brief patches. I still remember when we had the big, space launches, every time these stocks would perk up because that's the kind of momentum market we are in. What are your thoughts? I don't know if you track Paras specifically, but within the defense space, would you buy anything afresh?
Morning. Season's greeting to all your team at CNBC-TV18. Defense, yes, it has got a lot of potential. I think the potential has been there for the last 10 years. For the last 2 years, we've started seeing some action happening. But it is yet to percolate down to show up in any private company's numbers or an order book in a big way. You look at the large companies, basically, whether it is L&T or Bharat Forge, who have been in that space for a long period of time, spent a lot of money, basically, but I don't think so. They have still more than 5 or 10% of the order book is defense. So I think, yes, the potential is there, but I think it's going to be a long way. And these are all very long, drawn-out programs. So you have to be cautious, basically, when you are being over-optimistic about defense. At the moment, I believe people are over-optimistic about defense. I think it has got a lot of potential, but it is going to play out over a period of time. I am not going to buy any share of defense at the moment.
Okay, you're not going to buy any defense shares at the moment, especially because, the rally has been pretty large, right? Especially names like HAL, BEL. I mean, they are one of the top 100 arms manufacturing companies in the world right now. But I think a lot of that is perhaps priced in. You never know. But Nishal, morning. The other stocks that I wanted to talk to you about were the IT stocks, now coming out with their numbers next week. So it's going to be in focus. Infi, TCS, Wipro, HCL Tech. Would you buy any of these names ahead of the earnings, or are you cautious?
So I think this current quarter is going to be definitely in line with the first 2 quarters, which is sort of weak. And this quarter is going to have longer furloughs. So obviously, on a year-on-year basis also, you may not see very strong numbers coming out of the IT. But I think most of the market is optimistic about the future potential. And given that the interest rates are most likely to get cut in the US, you see that there is going to be increased spending across the corporate world in the US. And that's why people are optimistic. I'm also of that camp. Yes, current quarter is not going to be great, but I think every fall in the IT is an opportunity to buy.
Nisha, morning. Did you have a look at the latest CERC regulations, the draft rules on power? And what would your key takeaways be?
Sorry, we don't have an analyst on power basis, so we are not tracking that.
Okay. What about Dabur? Now, Dabur was this big laggard in 2024. In fact, the entire rural consumption was very sluggish and subdued. Are you penciling in some revival in the rural growth, which could benefit? We could see some sectoral rotation, money flowing back into names like Dabur?
I don't see any signs as yet of the revival, basically, and I'm a bit afraid, basically, that next year El Nino is going to be more pronounced than what we saw this year. So even in our current strategy note, we believe one of the issues facing the market is going to be rural revival. And that revival, I believe, basically is further pushed out. At least for the moment, I think because of high inflation at the rural level. I'm saying rural level historically has always had lower inflation than the urban side, but at the moment, both of them are having the same kind of inflation. And that's why you are seeing that the rural demand is a bit tepid. And I don't see any revival at the moment for them.
Okay, let's do one thing. Let's take a quick commercial break. We have about 15 minutes left for the pre-opening rates to kick in. The last trading day of the week. When we come back, Mitesh Thakkar and Kush Bora will be joining in for a quick technical check on the market. Stay tuned. Welcome back. Well, yesterday was a great day for the market. I mean, not too many people thought that this market would rally yesterday, but there was one person who did, and he's right here with us in the studio. Anuj joins in now for a quick trade setup. Anuj, get that crystal ball out and gaze in it for us. What's the prognosis today?
Yeah, I think I'll be a billionaire in 2 years. I guess so that's what I should have. That's
Can you forecast for us as well, Anuj? Like, what do you think we have in store?
You know what? Every day is not a Sunday. I mean, but I'm wishing that was a premonition yesterday. But anyway, it worked out yesterday. Look, I mean, yesterday the view was that the market had become extremely oversold just in the near term, and perhaps was ripe for a bounce. And bounce it got yesterday. But look, I mean, you still have to decide what is the trend. We all know that the large-term trend is positive, and the medium-term trend is also positive. What we are perhaps not clear about right now is the short-term trend. I think the short-term trend gets clear after today's action. If you start to close about 21,665, you start to negate the negative near-term trend. And if you close above 21,741, in that case, the larger trend, the near-term trend will also improve. I've written 19 by mistake. It should be 21,741. In terms of the cues to watch, you're watching out for two cues basically: earnings and quarterly updates, and the US bond yield. The US bond yield has once again gone back to 4. Now, as long as at 4, it's okay. But if it starts to go above 4.1, 4.2, then I think there's a bit of an issue, especially with the IT stocks. The dollar index also has been inching up, though to negate that, we have the Brent crude, which has been coming down of late. The other worry that I have is that 11 stocks have entered F&O ban, and it's the 5th day of the series. So obviously, there's a lot of exuberance in the mid caps and small caps. Anyway, that's what the markets do, right? In terms of Nifty outlook, the next resistance, as I said, is 21,741, and the support now comes in at 21,550, near about yesterday's low, and also where you have the options build up as well. The Bank Nifty is the one to focus on because it successfully defended its 20-day MA test. But the next move will depend on HDFC Bank's quarterly update, which should happen anytime, I guess, today or tomorrow. Here, the resistance is 48,400 to 48,450 first, and then the all-time high of 48,636. The support zone lies in 47,800 to 48,000, and then 47,200 to 47,300.
Okay, Anuj, thanks a lot for that. And once again, I mean, it was, you really stuck your neck out yesterday. No one thought that this would be the move, but you said it and it played out. So thanks a lot for that. We'll, of course, come to you yet again and chat more on the markets in a bit. But let's also get Mitesh Thakkar and Kush Bora into the discussion to find out which way the wind is blowing, because it's all over the place right now. Mitesh, hi, good morning. Volatility has picked up. So what is the prognosis for today? Do you just take a step back and allow this volatility to settle, or do you take any kind of positional call?
Good morning. My sense is that and Anuj was also highlighting this, that the medium term and the long term trend remain very healthy. What is possibly happening is that on an immediate basis, after a good rally, the market is trying to consolidate, and I've been making that point as much. So one, if you're trading with a 2-3 day kind of perspective, you need to be nimble about getting in and getting out of positions. I would expect a range of about 21,500, and in the worst case scenario, 21,250, 200 zones. 21,500 to about 21,850 is my broader range. I think we might see a couple of days more of consolidation within this range. And once we're done with that, then I think we'll possibly make a new high and get into a uptrend again. So for the time being, try to buy in declines if you want to enter, and try to take profits as we get closer to the earlier highs. And then, of course, you can be trading stock specifically if you want to avoid trading the range. And that's the way to approach it.
Okay, got that. Mitesh, stay on. We'll discuss stocks as well. Let's say hi to Kush Bora. Kush, good morning to you and happy Friday. So good bounce back by the bulls yesterday. Would you be looking at long trades on the indices, Nifty or Bank Nifty?
Hi, Sylvie. First, a very good morning to you and all the viewers, and a very happy Friday. In fact, it was a very happy Thursday, wasn't it? While the move was the move was very positive on both the indices, and there is options data suggesting that the support base rather has risen significantly. I think it's a little too early to call it out of the woods yet. Now, I'll suggest one reason why I'm of the belief. Over the last couple of years, what's happened is that the indices have actually surpassed the December highs before giving a bigger dent in January, and hence the cautious outlook. Even if we hit new highs on both the indices, let's say over the couple of next couple of sessions, I'll be cautiously optimistic, and I'll take every day as it comes. So for the near term, 21,500 is a strong support zone for the Nifty, 21,900 is a resistance zone, 47,700 on the Bank Nifty and 48,600 on the Bank Nifty as support and resistance levels.
Okay, let's get to some stock-specific trades then. Mitesh?
Good morning, Rima. I have more of buy calls today, 1 sell, 2, 3 buys. And on the buying side is Axis Bank. I think after a pullback for last few days, the stock is trying to get into an uptrend again. Buy here with a stop at 1104, targets of 1160 can be looked at. A buy on Chola Finance, which made a fresh swing high. Keep a stop below 1264, look for targets of 1370 in the short to medium term. And a buy on AB FRL, which is Aditya Birla Fashions, with a stop at 241 for a short-term or near-term target of 260. One sell call, that's Eicher, and Eicher has been going through underperforming as well as a declining period. It still looks like it will continue that. So sell here with a stop at 3915 for targets of 3750.
All right, thanks for that. Kush, what about you? What would you do with individual names? And what's your view on this rally in the real estate space? Do you think there's more follow-on buying here?
Oh, absolutely, Sonia. I don't think, investors should be selling out in profit booking here or there, depending on your investment levels is absolutely fine. But I don't think investors should be booking out. I was checking out a lot of names, on the charts. And despite the kind of moves that we've not seen any kind of overheating in a lot of names, and a lot of, stocks that hadn't really performed had started to contribute yesterday, suggesting that, there is some more, steam to the entire thing. In fact, I'll go ahead and say that not just the real estate developer stocks, the entire universe will do well. So the ply stocks, construction materials, all of that should be on the radar, and they will perhaps do well even from here on. The best way is to add a TSL, a trailing stop loss, and ride the momentum. As far as stock-specific action goes, 2 stocks, both on the buy side. L&T Finance, very clear breakout, volume-backed up move. So here on, we see the rally continuing to 176 and 180 levels in the near term. 168 is where I would place my stop loss. And Jyoti Labs, after a consolidation of good 5 to 7 sessions, this stock too has given a breakout yesterday. 514 and 525 are the targets, and 492 is where I would keep my stop loss.
Okay, all right, got that. Gentlemen, thanks very much for the trading calls. You have a good session, and of course, we'll see you a little closer towards market opening. Let's get back to Nishchal then. Nishchal, just want to discuss this huge run-up in real estate stocks that we've been seeing all through last year. And then, yesterday was quite something, 10 to 20% higher. Some of the business updates are in, but do they justify this sort of a move? And what's your overall positioning on the sector and the top stocks that you like here?
So I think historically we have seen these rallies actually earlier also. And fundamentally, I think most of these stocks basically are now at least 15 to 20% ahead of their NAVs. So typically you would look at a real estate stock, look at the future cash flows and discount it to the current year and look at an NAV. I think historically most of them have traded at least 5 to 10% discount. Now they're trading at 15 to 20% premium. I think the market has started discounting the future projects which they are going to undertake. We had seen this rally, this kind of a thing happening in 7, 8, 9, 10. At that time, basically, as soon as a project used to get announced, analysts used to actually put it into the numbers and put out a new NAV, and all those projects never came through. So I think we need to be cautious. I am positive on it because these are interest rate sensitive sectors. And if we are looking at rate cuts, which I'm expecting to happen next year, definitely I think you should be invested. I think wait for a correction in the sector for entry. But I think the larger stocks where there is a clear trend, something what we like is Brokerage, DLF and Macrotech. I think these are 3 stocks basically which we like in our book.
Nishchal, there's been a gold rush into these jewelry companies. Last year, Titan crossed the milestone of 3 lakh crore in market capitalization. The stock rallied 45%. Kalyan Jewellers has been a big mover, 195% gain in the last 1 year. And despite very high gold prices, consumption or demand continues to be very strong. If you'd seen the Kalyan Jewellers business update, 33% overall consolidated revenue growth in the Q3 quarter, aided by the festive period, but 40% in India alone. Would you bet on these jewelry companies? There are others also, like Senco, there's Thangamayal. Your thoughts on the theme per se, and which ones look attractive to you within that?
So we continue to be positive on this theme, actually, because last quarter and again this quarter, I think there is going to be something like a 30 lakh weddings is going to happen in the country. So I think that is what is driving it, basically. This is more, I think, maybe some marriages got delayed because of the COVID. And it is all happening in the last 1 year, 1.5 years. You're seeing a lot of this is happening, basically. That's why you're seeing this kind of a strong trend in the jewelry segment. So I think it continues to be on a buoyant space. What we are doing is basically now saying that you should book profits on Titan and go into the second line stocks, like Kalyan is a top pick out there, though it has hit our price target also. But I still continue to believe basically that it has got, as we roll on to 26, it will have more upside from here. So Kalyan is the one which we are looking at. Others we don't cover at the moment, but I think it's good time to take away some profits from Titan and maybe get into the second line stocks.
All right, interesting there. So a good time to move some money from the large caps to the mid caps in growing sectors like consumption and jewelry. Got it. Let's take a quick break. On the other side, the pre-opening rates. We will also talk about the power space. Harshvardhan Dole, Senior Vice President, Institutional Equities at IIFL, will help us discuss the new CERC draft power tariff norms, what it means for individual stocks. More on that coming up.
Well, the pre-open rates are coming in, and if there's anything to go by, it seems the momentum will firmly remain with the bulls today, because the Nifty in the pre-open is up a whole 100 points once again. And what's leading it is NTPC. I mean, the power story is something that we have been discussing. You're seeing some traction on Nestle India. Nestle, by the way, I think is also going to go through a corporate action. We'll get back to you on that in just a bit. And then you have TCS, LTI, Mindtree, some of these technology names also, which are up and about. Now it's become a little more muted, about a 70-point up move on the Nifty for the time being. But Rima, tell us what's the momentumizer of the day? Which stock is catching your eye?
Inox Green. The stock was up 6% yesterday. It's rallied 36% so far this week. In the last 1 year, it's up 215%. Yesterday, it also hit its lifetime high levels of 149.5 rupees. Now, the stock has also been inching up on very high volumes. So yesterday and the day before, that's on Wednesday and Thursday, the total traded shares, on Inox Green was about 2 crore shares versus, which is double of the kind of volumes that we typically have. The average of the last 1 month is 1 crore. And also the delivery volumes have doubled. So this is the stock that I'm keeping on my radar. I checked with Vivek that does it benefit in any way because of, this whole power renewable, the CRC, guidelines. He says it doesn't, but there is clear momentum in Inox Green today.
Okay, there's clear momentum in Inox Green. By the way, we're just waiting for the pre-opening rates to kick in and settle in right now. So just, let's give it some time. As we were telling you, plenty of stocks that could be in the green today. So there's RBL Bank, where the loan growth was very strong, 20% in Q3. There's Dabur, where the company is talking about early signs of revival in the consumption sector. There's Soba, where this is the highest ever quarterly sales for Soba. So that one perhaps could be building on to its gains of the last few days. And then there's Kalyan Jewelers. So these are a couple of big stocks, or other stocks in the news this morning. But Nishal Maheshwari is still with us. Nishal, over the next few days, we could get the business updates from HDFC Bank. And then you have their numbers coming out on the 16th as well. In the run-up to the earnings, how are you feeling about the bank itself and the kind of performance we have seen so far?
I think most of the banks which have come out with their business update, I think they've been pretty robust, actually. The smaller banks, given that a lower base they were coming from, basically most of them shown pretty healthy credit growth. I'm saying as low as high as 40% to what you said just now. RBL is something like a 20% kind of a growth. So I don't see any issue as far as the credit growth is concerned in the banking sector. Again, on the asset side also, I think most of the banks have continued to maintain that still the Goldilocks scenario continue as far as the asset quality is concerned. The only worry which I see here is basically that all of them have shown issue about on the liability side. So most of them have lost CASA in the current quarter. Most of them have seen deposit growth being lower than the loan growth, which is a cause for worry basically, because that will increase the cost going up as we go ahead. So that is the only worry which I see on the banking side at the moment, that the costs are going to go up, especially on the liability side. But otherwise, a pretty healthy growth in the current quarter.
Okay, got that. Nishchal, thank you very much for joining in today. Good chatting with you. You have a good session and, of course, a good 2024 as well. Well, with that, let's move on and discuss one key sector that's going to be in focus today, and that's the power space. The power sector regulator, CERC, released a draft paper on electricity generation tariffs, which will be applicable from the 1st of April 2024. The norms will be in effect for 5 whole years, so it's for the next entire cycle. And while a lot of the ROE levels have been retained, in some cases, like for power grid, there's a minor cut, and for hydropower projects, the ROE has actually been increased. So what's the potential impact and how should we read these regulations? We have Harshvardhan Dole, Senior Vice President, Institutional Equities at IIFL with us. Harsh, thanks for joining in. And I'm talking to you for the first time in the new year. So first of all, very happy new year to you. I just started going through your morning note where, you're going with the description of these norms as very balanced. So can you expand on that and tell us, let's start with thermal power companies like NTPC. What's the impact?
Thank you and greetings to you as well. So if you actually go through the draft, the reason why we think it is balanced, it gives a regulatory stability. That means the return on equity for all the operating assets is by and large retained. For example, NTPC's existing units will continue to earn 15.5% assured rate of return. Power Grid will continue to earn the same set of return, and so would NHPC. So there is a regulatory stability. What is more important is the regulator has sort of given a bait to bite for these utilities so that they can take risk and produce power at the peak time when India needs it the most. For example, in case of NTPC, they've said that in case your plants are able to operate during peak time, there is an incentive of 20 or something like 10 to 15 paise extra per unit, which is quite significant. Similar incentive is actually being given to NHPC in a form of additional monthly charge. Plus, if they're able to generate over and above what they're entitled to, there is an incentive thereof. So looks like the regulator has been forthcoming and trying to address the emerging trends rather than trying to fix the existing issues. So to that extent, I think it's all thumbs up.
Okay, so sorry, just to take that point forward, for NHPC, for hydro assets, where the ROE has gone up, is there an immediate benefit for stocks like SJVN or NHPC, or are you saying that it's only when you cross generation above a certain threshold? Is there straight away an EPS increase that comes in or not?
Yes, there is. So, for example, based on our initial assessment, looks like for NHPC, at least the EPS impact will be at least 3 to 4%. That's A, for the operating assets. For all the new assets, the ROE has actually gone up by 50 pips. So that should also get in at least 50 to 80 crores on a recurring basis. So there is definitely a 3 to 4% impact on NHPC's recurring earnings.
Okay. For transmission, there is negative news. Could you tell us why the draft regulations are negative for a company like Power Grid?
I wouldn't say it is extremely negative for 2 reasons. One is the operating assets continue to fetch 16.5% assured rate of return. So there is a regulatory stability. For all the new plants which commission or new lines which commission, beyond FY24 will earn 50 paise less rate of return. However, bear in mind, in case of Power Grid, all the new projects are bid out on a competitive basis, and only a handful of projects are awarded to Power Grid on a nomination basis. For example, the Leh-Ladakh line, which is a fraction in their overall portfolio. So again, it's sort of tweaking rather than a major negative. I don't consider that to be a huge negative. It's sort of some correction that probably regulator wanted to do.
Have you assessed the impact on NLC India after the changes that we've seen?
I think broadly it should benefit NLC as well. It tries to fix the return on equity for the mining aspect. B, it also takes into account the plant availability factor for the innovative technology, which is CBFC technology, which has got teething issues while settling the unit. Their path for earning the threshold rate of return has been reset to a lower level. So that should address some amount of their under recoveries and hardship encountered by them. So directionally, it appears to be quite positive even for NLC.
So overall, can you help us with, just to summarize for us, what are the top picks in the sector now and what is the pecking order looking like post the norms?
So I think the biggest gainer seems to be NHPC, followed by NTPC. And based on these tariff regulations, look like our conviction on NTPC has actually, in fact, gone up further. So that continues to be our top pick in the sector. If at all one has to go down the line, then the other beneficiaries could be Torrent Power and CESC, which don't directly benefit from these regulations. But from the tone of regulations, it appears that the government is very serious in terms of implementing reforms in the sector. And these two stocks, in my view, are well placed to benefit from the reforms. So from a top pick perspective, I think NTPC, Torrent Power and CESC are the three stocks that we continue to like in the sector.
Okay, just 1 second, Harshvardhan. We just had the HDFC Bank update flash, and that's the combined might of HDFC along with HDFC Bank. You have, the merged numbers and the update really coming in. If I read the numbers right, I think 62% or so growth in advances, deposits also. But those numbers are very, very strong because you're getting the merged entity numbers in. And 62%, that's 62.4%. That is not a number that you can take lightly. I will get in Abhishek to give us some more color on this and more perspective on this in just a bit. But Harsh, just to come back to the point on NTPC, I mean, you've been positive on that stock for a while anyway. It's had a superb run, 90% up in the last 1 year. What is your current target price and the immediate triggers for NTPC? I mean, how much of an EPS increase would you start penciling in because of these norms? Because now if you're generating above certain thresholds and you have added incentives, right, like you mentioned. So what is the additional EPS you'll pencil in because of this ERC norms? And what are the fresh triggers? And also tell us your target price right now on NTPC.
So if you do back of the envelope calculation, looks like NTPC is set to gain at least 600 to 700 crore prima facie based on this tariff order. So for a company with a profit of 18,000 crores, it's a reasonably high impact. But rather than tweaking these numbers, I think directionally the regulator has given a very good signal that hey, we are there with somebody who's serious and willing to invest in the sector for long term. And that is the basis for our buy recommendation on NTPC. That if you were to look at the reverse cash flow growth for NTPC, at current market price, the reverse cash flow growth from here till say maybe next 15 years, the implied growth is about 8 to 9%. We think that still the valuations are quite reasonable. And unless the reverse growth throws a number which is 15% plus, which may imply a stock price of more than 400 plus, I think valuations will continue to be fairly stable. So as of now, we'll await for the final regulations and then take a call to revise the target price. But looks to be a safe name to be in the overall sector.
Okay, got it. Thanks a lot for joining us, Harsh. Have a good weekend. That's IIFL with their view on the power space. But definitely the center of attention now is HDFC Bank's Q3 numbers. Everyone's busy analyzing those numbers. So let's see what the market's verdict is. If we can get the HDFC Bank stock in pre-opening. It looks like, prima facie looks like an okay set of numbers. The merged numbers, the gross advances up 62.4%. Domestic retail loans up 111%, but some more nuanced details on the numbers in a bit. For now, the HDFC Bank stock is just about flat with a bit of a negative bias. But let's see what the charts are looking like. Mitesh is here with us. Mitesh, how is the HDFC Bank chart looking at the moment, and what is your own 9-10 call?
So on HDFC Bank, it's had a good rally from sub 1500 to about 1720, and now it's giving a pullback. I still believe that around 1660, 1670, if you get it, that's a very good entry point. Keep a stop below 1645, and I think the stock will clear the recent high of 1710 and head towards 1750 odd level. So very, very positive outlook and buy and declines kind of strategy. And on the 9-10 call, I would go with a buy on Axis Bank with a stop at 1104, targets of 1160.
Okay, thank you very much for that. Let's go across now to Sonal to talk about real estate, the way these stocks rallied yesterday, what the delivery volumes were, and even a word on the business updates from the likes of macrotech developers. Sonal, over to you.
Thank you for that. Well, look at the way the stock surged yesterday and just take a look at the delivery stats as well. For Sobha, the biggest gainer, delivery was just 10% of the quantity that was traded. For Godrej Properties, 21%. For Prestige Estates, it actually bucked the trend, saw 50% delivery yesterday in terms of traded stocks. Brigade Enterprises, 26%, Macrotech, 23%, Sunteck Realty, around 36%. So the stock that surged the most saw the least amount of delivery in trade yesterday. So that just tells you the kind of moves that we saw in this pack yesterday. But now let's talk about the fundamentals, because Sobha was the one which was the top gainer, and Q3 update was strong for them. Sales growth of around 37%, volume growth of around 21%, average realizations up 21.5%. The company says that cash flows were strong again and they've been able to reduce debt yet again. For Macrotech developers, it was not as exciting or strong as Sobha. While they did see a growth on a YY basis, sequentially it was a decline for the company in sales. Collections were down 3% on a YY basis. Net debt is flat on a sequential basis, has declined on a YY basis. They say they are on track to achieve their guidance as well.
Thank you for that. Right on time, Sonal. Thanks. It's a good opening for the market, by the way. After yesterday's move that we saw on the upside, looks like the pullback continues. 60 points higher for the Nifty now, hanging on to 21,700. The good part is that there is participation from the broader markets as well. The mid-cap index is up 240 points currently. So across the board, actually, the momentum is good. The advance decline ratio is at 2,000 stocks in favor of advances. What's leading the gains this morning? I'm very curious to see what HDFC Bank's reaction is to the numbers. So let's just get that stock first up on board. Okay, in the green, so up 0.5%. The street definitely liked those numbers. Prima facie, as we said, it looked pretty decent. So stock is piling on some weight over there. Apart from that, you have NTPC, LTI, Mindtree, Ultratech Cement, BPCL, ITC that are all in the green. Tech stocks are looking pretty good as well. Tech Mahindra, Wipro are all in the green as well. And then a couple of other names, Tata Steel, Coal India, Dr. Reddy's, Tata Motors, all in the green as we speak. On the downside, though, some of these consumption names are just under a bit of pressure. So, something like a Britannia. Then you have Infosys that's flat. Asian Paints as well is down about 0.2%. But just look at the market go now. 85 points higher on the Nifty. We were telling you that there are two positives the market is working with today. One is lower Brent crude prices, and the other is that FIs have come back in a big way. There was large buying by foreign investors yesterday to the tune of 1,500 crores. We also saw record demat accounts in the month of December. So all of this is leading to a positive sentiment in our markets. But broader markets also looking pretty good.
Broader markets looking good. And this power story is playing out really well, because on the Nifty, it's NTPC, which is leading the charge, 2% higher. Beyond the Nifty, it's NHPC, because that is a stock which gets an added fillip. The ROE, permissibility levels, the tariffs have been increased by 50 basis points for all new projects for NHPC. And that's working really well for that counter. SJVN should also benefit, incrementally for all the hydro projects they put up. So even SJVN is up about 1% thereabouts. Beyond the news flow, let's see what else is standing up. A lot of the stocks which have come out with their quarterly updates, they are trending higher. So Kalyan Jewellers, for instance, 4% up despite its breathtaking run, continues to move up. RBL Bank is up and about. Macrotech Developers is reacting well to the update. Sobha is cooling off right now. Bit of a sell-on news playing out after 2 absolutely intense days of price action on Sobha. By the way, on the power side, look out for Torrent Power. That stock's also flowing through. So in general, CESC has also got the first positive tick on it. In general, it's turning out to be a very positive start for the power setup. L&T Finance, 1% higher on the update. J&K Bank, Equita Small Finance Bank. So all of the BFSI names that have reported numbers, they have started the day on the positive side. Beyond the newsmakers, let me just look out for any other stocks that could be catching the eye. Well, on the mid-cap screen, the index itself is still up about 0.5%, so it's pretty good going. Names like Cupid, I mean, some of these lesser talked about stocks, India Glycols, so they are up and about. But I think we're building on momentum, Rima, so it's about 80 points higher, not a bad start at all.
Oh, absolutely. And in the face of listless, flat global cues, right? Asia is doing absolutely nothing across the various indices, but the Indian markets are continuing with the bounce back from yesterday, and we've added on 85 points. Mid-caps are up, the mid-cap index up more than about 200 points, very positive advance decline ratio. Some of the real estate companies are, continuing with that momentum. We spoke about Macrotech and Sobha. Sobha, of course, has cooled off a tad bit, but Indiabulls Real Estate has seen some buying, and you also have Peninsula Land, which is up and about. Apart from that, you've got these jewelry companies looking up. So Kalyan Jewelers, which reported a 33% jump in its consolidated sales in Q3, is up 4%. Moti Sons Jewelers, a small company, recent listing, and that's seeing some buying, and that stock has gained close to about 5%. Dabur, where they reported the Q3 business update, the stock has opened with a mild positive bias. Not too much, but just tracking the commentary from the company where they're saying that there is some improvement in consumer demand, though rural continues to lag the urban demand. So Dabur has opened up with a gain of nearly about 0.5%. But now NHPC is seeing some aggressive buying, 8.5% higher on NHPC, and it's moved up on very, very large volumes. So that's clearly one of the big stocks of the day. Let's now go across to Rahul Arora, the Chief Executive Officer at Nirmal Bang Equities, who's here with us on the show now. Rahul, hi. Thank you very much for joining in. In the face of listless, subdued global cues for the last 2 days, the Indian equity markets continue to march on. Just for the near term, considering there is that weak January seasonality, and typically markets correct in the month of January, what would your near-term outlook be for the markets?
So first of all, morning, and thank you for having me on, and I wish all of you a very happy New Year and to your families and team as well. So I think this reminds me a bit of 2013 when the Prime Minister, then the Chief Minister of Gujarat, was announced as the PM candidate in September 2013. The rupee was at 69 and the markets were a bit listless. But in the run-up to the general elections, the markets had a very ferocious rally and the rupee appreciated by almost 10%. I think something similar could happen. The day the state election results were announced, the Nifty was at 20,000 or just maybe a little under. You've already got almost 10%. I think the other important factor, Rima, will be that I think the RBI will probably allow the rupee to depreciate a little bit because India is now included in the JP Morgan index. Now, when those flows come, the rupee will appreciate quite substantially. So I think there will be an interim period where the rupee will depreciate and then appreciate again. I think net-net you'll probably land up being at around 83, 84 for the year. But that probably plays itself out. From a valuation standpoint, I don't think anything can be justified on an FY25 basis. So if you're a retail investor and coming into the market or even an institutional investor, you need to have at least a 2-year view. Otherwise, if I look at our own broking firm, we track about 185 stocks. I would shudder to think more than 20% would be buys if I value them on FY25. So obviously liquidity has played its part. And I think the overriding theme next year is going to be the rate cuts, right? I think the Fed has already indicated 3 quarters. There are some indications the RBI will follow, if not 3 quarters, by at least 50 basis points. So it's going to be a strong period of the market till May. I would not be surprised if this rally continues till 24, 25,000 by May. The question is what happens in the second half.
Sell the news?
I'd say we're probably going to more of a consolidation phase because if the worst of China gets behind us in the next 6 months, then that emerges as a competitor for capital in the next half. And let's not forget the US and India both go to elections next year. So the US is also going to be fighting for capital. So I think in terms of major flows, it's going to be US, China and India. But I think India could potentially be more front-loaded. And you could land up seeing a 24, 25,000 Nifty by May, and then you go into a consolidation phase for the second half.
I like that. I'm going to take that. 24, 25,000. That's the optimism we need this Friday morning, right? But jokes apart, Rahul, thanks for joining in. Happy New Year to you. I wanted your thoughts on the here and the now. I mean, we are reacting to HDFC Bank's numbers and they're looking really good. I mean, deposit growth of almost 28%, retail deposits up almost 30%, right? This is one behemoth that has not really performed. I mean, it could do better, especially in people's portfolios. But your thoughts here?
So I think, Sonia, this is a bank that's going to grow its net interest income. Its pre-provision profit and PAT by about 30-35% over the next couple of years. Obviously, this is a merged entity now, so we're strictly not talking about standalone. But these are exceptional numbers. Now, as you rightly pointed out, there was a time that HDFC Bank used to trade between 4 to 5 times price to book. On our numbers, that's probably come down closer to 2.6, 2.7. But that's not just true of HDFC Bank. It's true of HDFC Life as well, where on price to embedded value, that stock post-listing had gone to about 5.5 times. Would I be a buyer in this stock? Absolutely. I think there are no concerns. RBI has already adjusted for risk weights on retail loans. So I think incremental retail lending, if you had to doubt anyone in the banking sector, I don't think you had reason to, but if you had to, that'll get a little more prudent right now. The only thing, Sonia, is that because you are going to go into an interest rate cut cycle, my sense is you might see deposit rates at the short end go up a little bit more. So you might find, and some banks are already doing that to garner incremental deposits. So I think if at all you want to say the worst of the banking sector, though that phrase technically does not apply, would potentially be this quarter, because I think NPAs come FY25 will start to look better. NIMs would have bottomed out and credit growth is extremely strong. I think if you look at scheduled commercial banks, they're almost 16-17% growth. If you exclude HDFC Bank, and if you include it, it's at 20%. If the Nifty is to go to the levels that I think, it's going to be led by banks, and I think it's going to be led by HDFC Bank. So I would certainly be a buyer. We're expecting very strong growth, and I don't see any reason why retail or an institutional investor should not be adding at this point.
Rahul, hi, morning and season's greetings to you. Let me say that the beauty of age is that you lays optimism with some healthy cynicism as well. I don't remember the last time we started a year with the narrative so positive. But look at the updates, and there's no denying the numbers, right? Look at what real estate companies are saying, banks, look at the way credit offtake is, flying off. Then the rate cut narrative, obviously, which is here. The money flows coming in from foreign investors. We're talking political stability. It's almost too good to be true. It's too perfect. So therefore, let me bring in the healthy cynicism. Are there risks that we should keep in mind, or should we just prepare ourselves for a melt up, like you're saying, in the run up to the elections, and just keep the pessimism and the questioning aside for a bit?
No, I think it's a legitimate point. I don't think everything is, in life, personally or professionally, nothing goes up in a linear fashion. You have moments of consolidation and disappointments at every point in time. The one big call that the whole world got wrong, and I was reading reports by, BCG, McKinsey, and a lot of others, and sell side by side, was that the US would go into a recession in the calendar year 2023. That did not happen. Now, does that get postponed to 2024? That's a big question mark. And how long does this China slowdown last, right?
But that's not a worry for the market. Sorry to come in. If they go into a recession, you get 4-5 rate cuts, and the market loves that, right?
No, so I think there is a growth trade-off as well. So our own economist, Teresa, expects that, this year's GDP growth will be about 6.5% for FY24. That may come down to 6.2% next year. You don't have to incrementally find negatives if they are not. But yes, the biggest negative is, as I said, near-term valuations. You've had 2 wars hit us in the last 3 years, and crude is comfortably placed between that 75 to 85. So I think next year, if you have a current account deficit at about 1.5%, if your CPI average is about 4.5, 4.8%, WPI at 2.8%, there may be a bit of slippage on the fiscal side because rural has not recovered to that extent. So you may find some amount of grants to, boost the bottom of the pyramid. But then even so, if it's a 20-30 basis point slippage, I don't think people are going to scoff too much at it. So my only concern would be on the export side, where if you have a global slowdown, what's going to happen? But even then, just to play devil's advocate, if India continues to grow at 6% plus in an interest rate cut scenario, even the global growth slowing, and if you have capital, then you still become the receiver of that capital. So, it's a very famous Devanand song, and I think it's probably apt for the Indian markets right now. Even if there is any wall of worry, मैं जिंदगी का ख्वाब निभाता चला गया, हर फिक्र को धुएं में उड़ाता चला गया. So on those lines, I think you got the drift. So I think it's always prudent to be cautious. I think near-term valuations are concerned, but no headwinds as such. And if China remains soft, commodity prices are again in your favor. So I think it's enjoy it. I mean,
so evergreen Devanand, evergreen Indian markets as well, right? But let me ask you about consumption. That's a space you track very closely. Now, 2023 turned out to be pretty good for consumption names, aided by falling inflation. So gross margins went up, EBITDA margins went up across the board for FMCG companies, and that drove the EPS growth estimates. What about 2024 now? What's the outlook?
So, Rima, I'm still not comfortable paying these valuations for consumer staple companies, and I'll tell you why. Because I think if you look at frontline IT, right, the 5 companies, and you look at, say, the mature FMCG businesses, these have now, I think, come to a stage where to get a 10% plus top line growth is going to be very challenging for them. I'm not talking volume growth, I'm talking about revenue growth. This includes, for FMCG, it includes volume, pricing and premiumization, and for IT, it could include rupee depreciation and volume growth. So if I get into so I'm looking at a 5% pivot, right? So I think in bad times that probably drops down to 2-3%, in good times at 8-9%. At 8-9, if I have visibility of 8-9%, then these companies go back to valuations of 50-55 times. But at this current valuation, to be buying stocks like Lever, Dabur, etc. on the staples, I'm not sure. Consumer discretionary, very bullish. Even now, for the next 1 year, completely. You've had G20, you've had the World Cup. You have a very big tourism event later this month opening up in Ayodhya. So I think that's going to, have an impact on air travel and tourism as well in terms of hotels. So consumer discretionary, I have no problems, but consumer staples, still not yet. And as to Surabhi's point a little earlier that I was saying where fisc may slip, I think the government will have to do something at the bottom of the pyramid to revive that because I keep making this point. The reason Lever stock went from 300 to 3,000 is because margins went from 14% to 25%. Lever's top line 10-year compounded, and that's a reasonable time frame to take across cycles, is only 8.8%, and that includes volume, premiumization, and price. So, and when you talk about all of these, and there's a play on grammage, etc. So, I need these companies to go to about 6, 7, 8% volume growth for me to be comfortable paying these valuations.
Okay, all right, got it. But before we let you go, you spoke about all the big events coming up, and there's the union budget as well. There's a pen and a paper there for you, and there's a huge box next to you.
I see.
Ballot box. That's a ballot box, and that's your attempt to get your message sent to the finance minister directly, so that she can present her budget with all of this feedback in mind. So go ahead.
Yeah, sure. Why
and
not?
also tell us what you're writing.
Tell us what you're writing.
So I think this is the budget actually is going to come out in July, right? This is going to be just a vote on account. But I think there is going to be a situation where you're going to have a little more rationalization in the taxation because you're moving to a stable tax regime. Like I said, I think some government spending at the bottom of the pyramid is what probably looks like it's going to happen. But I think anything incremental is going to be only announced in the budget. But I think the fact that the 2 terms of the Prime Minister have been devoted to regulation and putting India on the global map, I think the next 5 years are going to be all about the economy. And I think given what he's spoken about in terms of indigenization, I think it's going to be a great time for industrials, for banks lending to industrials.
Local
and I
manufacturing.
think, and, I remember Rukshaad Shroff of JP Morgan at one of the CFA conferences, somebody asked him years back, which is the next HDFC Bank? And he said HDFC Bank is the next HDFC Bank. And, and I was having this conversation with someone recently and we were discussing with an institutional client who's a large holder of Dixon and he's like, kya karu? The valuations. And the question was, can Dixon become the next Dixon? And just I'm giving it as a metaphor because, when you talk about China plus one in India, there are only 3 or 4 large cap chemical companies in India. Could you have this go to a situation where this becomes much, much bigger? So I think the government will probably want to focus a lot on manufacturing and infrastructure. But for the moment, like I said, it's predominantly a vote on account. So I think there may be something for the bottom of the pyramid, an indication on taxations in terms of consolidation. But I think the big bang announcements will probably come through June. So that's July. That's probably what I'm going to write down. But
absolutely. Well, while Rahul writes down his sort of thoughts and requests and his wish lists to
that's a long one.
To the finance minister.
I think he's going to spend the next 1 hour.
I really hope she hears him on the tax part. I mean, in terms of rationalization, we go in with that hope every year. The middle class hasn't gotten too much. The corporates got their corporate, tax rate cuts, which really spurred so much of enthusiasm. But for the middle class on taxes, so I hope she's really listening to that particular number. But as you know, that's the ballot box. Rahul, go for it.
I'll just put on my top 3.
Just a caveat here, right? Nirmala Sitharaman herself said that don't have any expectations from this one because it's just a vote on account. The main budget will be, of course, post the election. So before that, there's no major announcement. So we have expectations, but she's saying don't have them.
On a lighter note, extremely on a lighter note, since it's a Friday, this is probably the closest I've sat to.
Hopefully someday you'll be sitting right next to her.
Thank you, Rahul, very much. Great chat as always. And once again, wish that it's a great year for you and your team, and personally and professionally. All the best to you.
Thank you.
We were just discussing HDFC Bank, so let's straight away get to it, because we've had those blockbuster numbers, 62.4% growth in advances. That is the power of the merged behemoth. Abhishek, tell us more.
Well, just to smoothen things up, the merged numbers, that is why you are seeing such a growth of 62%, because they have HDFC Limited numbers now in their balance sheet. So to begin with, HDFC Bank's Q3 performance looks strong even on a sequential basis. There is strong loan growth momentum that you are seeing over there. Deposits are up 27.7% YOY and about 1.9% sequentially. Remember that YOY, they have a base effect of being a standalone entity versus the merged entity of HDFC Limited with the bank. Advances growth is at 62.5% YOY and about 4.9% sequentially. There is improvement in credit deposit ratio to 111.5% when compared to 108.4% in the previous quarter. Now, CASA has also inched up a bit, 13.5% growth YOY and about 2.2% sequentially. You are seeing a slight increase in CASA ratio sequentially to 37.74% when compared to 37.63% in the previous quarter. Retail deposits, that's been a strong point for them, grown at 2.9% quarter on quarter. So retail deposit growth is higher than the overall deposit growth, because the wholesale deposits are down 3.4%. So the high cost bulk deposits or wholesale deposits are down, which is good in terms of cost of funds being maintained stable or seeing a decline over there. Loan growth breakup, domestic retail is up 111% on a YOY basis and about 3% sequentially. Commercial and rural banking is up 31.5% YOY and 6.5% sequentially. However, the corporate and other wholesale loans, they are up just 11% YOY and just 2% sequentially. Back to you.
All right, Abhishek, thanks a lot for that. Very helpful there. So that's HDFC Bank. But just wanted to point out that the stock of the moment is macro tech developers. Just pull that stock up for you. Another 10% rise is what we've seen in macro tech. Big volumes piling up. This despite the numbers not being that great. So it's really sentiment that's driving the real estate sector at the moment. Of course, numbers are good, but the momentum is so strong in this space that there's gains that are getting piled on. Another sector where the momentum has been strong for the last 2 years is defense. In fact, BEML is one of the big winners of 2023. The stock has more than doubled in the last 1 year. The company has orders worth 329 crore rupees from the Defence Ministry. In fact, the Defence Secretary, while speaking to CNBC-TV18, said that production is likely to cross 1.5 lakh crores in FY24. To discuss the opportunity, we have Shantanu Roy, the Chairman and Managing Director at BEML. Shantanu, thanks for being with us. Happy New Year to you. And, it's been a super run for the sector. We were just having a chat with the management of Paras Defence, and he said that this so-called number of $77 billion annual spend by the Indian government in defense is conservative. He's saying that the spends could be much more in the year to come. I wanted your thoughts on what the opportunity for BEML is over the next 1 to 2 years. Can you share some numbers with us? What's the order book now, and what is the order visibility over the next couple of years?
Very good morning and a very happy new year to all of you. Yes, there has been a lot of good opportunities for companies like BEML in the manufacturing sector, especially because we are in the defense and rail and metro, both the verticals. And these are the priority areas of the government. As far as defense is concerned, we are very optimistic about the overall manufacturing scenario of defense production. As far as BEML is concerned, if I talk about the order that we have just got, it belongs to a family of mining and demining equipment, which is very essential for our defense forces. And it belongs to the family of the combat engineers, which includes the bridging systems. And we are, it's one of our core competencies. This product itself, this family itself, I'm looking at a number of around 2,500 to 3,000 crore in the next 4 to 5 years. The overall defense order book that I can see, the defense opportunities in which BEML is present in the next 5 to 7 years should be around 30 to 40,000 crores for BEML alone. And if we talk about the other verticals, the rail and metro, the rail and metro put together, in the near future, we should have an order book. We should have an opportunity size of around 45,000 crores in the next couple of years, if all goes well. So that augurs well for the company. And we also have the third vertical, which is the mining. And mining, it's very steady, it's very constant. And mining has always contributed the baseline to the company's top line. And last year, mining contributed 50%. This year also, I'm expecting it will contribute around 40 to 50% of the top line. And mining will always have a steady growth because, again, the government's policy and aspiration to go for indigenization of the high-end mining equipment, where we are very strong. So it augurs well for the organization.
Okay, so just wanted to clarify some numbers. You said 30 to 40,000 crore is the opportunity in defense orders over the next 5 to 7 years, correct?
Yeah.
Okay, and for FY24, your order book guidance, you had cut it to 14,000 crores. You had said that some orders are getting pushed out. Is that a number that you hold on to? And what is the order book guidance for FY25?
FY24, I'll still maintain 14,000 crore. You see, right now, my order book is around 12,500. We are expecting around 3,500 crores in the next 3 months. So we will execute some of those. So we will end the year at around 14,000 crore. And if all goes well, FY25, we should end the year at least 20 to 25,000 crore of order book.
Okay. Mr. Roy, since import substitution, Make in India indigenization has been such a big theme for players like you, can you tell us that earlier in the spaces that you operate in, what was the extent of imports and what does it currently stand at?
The impetus on indigenization has really been very helpful for companies like us, not only in terms of increasing our top line, but also at reducing our costs. Earlier, if we talk about defense, the indigenous content was only around 60 to 65%. But now, with the indigenization impetus, we are able to achieve around 95% indigenization in most of our platforms, most of our products. As far as the rail is concerned, in rail, already we are at levels of around 80-85%. In metro, yes, it's a bit low, around 65%, depending on the type of requirement of each metro corporation. But as far as mining and construction is concerned, we are more than 90% indigenous content in that particular vertical. So definitely we have come a long way from being importing to indigenizing and creating a supply chain in the country to cater to our requirements.
Okay. Mr. Roy, hi, good morning, season's greetings. So big numbers there on the order book position and of course the opportunity, right? But I want to come down to revenue and execution because when we talk to people in the stock market, I mean, everybody really cheers the huge ordering that's happening, but people are also concerned about how quickly that starts translating into revenue and profits. And if I look at the historical track record, then, it's not been a straight line growth because in FY22, your revenue was above 4,100 crores. In FY23, dipped a bit to under that number. First half of this year, you've done, I think, just under 1,500 crores. So what kind of a pickup in execution can we expect in the second half? And when you talk about this opportunity, big ordering opportunity, in terms of even an annual revenue run rate over the next couple of years, what's a steady state run rate that investors can perhaps expect?
You see, let me talk about the historical data, the historical performance. Historically, our execution has been like 10% in the first quarter, 20% in the second quarter, 30% in the third quarter, and 40 to 50% also in the last quarter. That is how historically we have been doing. As far as the execution, as far as the run rate is concerned, you see straight away the execution cannot happen in most of the orders because there is a gestation period. Except in mining construction, where we have a very short turnaround time of maybe 5 to 6 months in most of the orders. In rail, the gestation period, rail and metro, it is around 24 months to start with when we build the first proto and then we start the manufacturing. In defense, it is a bit shorter as compared to rail and metro. So immediately execution definitely cannot be done. So we have to focus on the orders that we already have for the execution to take place for the next year. So
No,
it will not be, yeah. So,
so absolutely, I get that point. I get that point. You know, that is the nature of the business. But then you have an order backlog, right? And that's why it'll help if you can give us some sense on, you know, at an annual level, like FY24, for instance. Do you think you can end with 5%, 10% top line growth? And just a word on margins as well, because that's something that investors have really liked. Your margins have been consistently improving. So perhaps some guidance on whether you can maintain these levels of about 9% or not. And just top line growth this year, FY24, what could it be?
FY24, you see, we have targeted a 20% growth. And
in revenue.
It seems possible. It seems possible as I talk to you. FY25, we will again target 20 to 25% growth, our top line. As far as the margins are concerned, if you look at our half-yearly results, we have already reached an EBITDA margin of around 7%. So I want to end the year with at least 200 basis point growth over last year's EBITDA, which was around 9.3%. So that is the outlook, that is the aspiration that we have. All goes well.
Got it. Okay, so 20 to 25% growth in FY25 is what you're looking at. Before we let you go, we have the big union budget upon us. Of course, this time around, it's only going to be a vote on account. But the government has its sights set on growing the, defense sector quite a bit. So from the budget, either this time or post the elections, what is your key expectation? What are the, gaps that still need to be filled in this sector?
As far as BML is concerned, the key expectation is that this impetus on defense spending and infra spending should keep going because the top three budget outlays for 23 was defense, rail and metro and infrastructure. And these are the three verticals, these are the three areas which I call the sunrise sectors where we are in. And we'll be hoping that the government keeps up the same momentum in these three sectors so that it augurs fantastically for companies like BML.
All right, sir, thank you very much for joining in. By the way, IT is making quite the comeback today. Wipro, LTI, Mindtree, Tech Mahindra, Infosys, TCS, all these stocks are seeing gains anywhere between 1.5% to 2.5%. Wipro is the second largest gainer now on the Nifty, and the IT index itself is outperforming by quite a margin, 1.6% gain on the Nifty. IT versus the Nifty up 0.3%. Get into a break. We'll come back. We'll talk realty. We'll be joined by Samantak Das of JLL India, Niranjan Hiranandani of the Hiranandani Group, and Irfan Razak of Prestige to talk about the outlook for the real estate sector next year. Welcome back. This is Corporate Radar. Now, a CNBC-TV18 poll on home buying has revealed that most developers expect sales volumes of new homes to go up even further in the new year. These results come on the back of 2023's astounding highs in the residential sector. The developers we polled say that they are betting on the mid-range segment. Repo cuts and continuing ownership aspirations are the key drivers of this. Jude Sanid joins in with a roundup of this poll.
An overwhelming majority of developers who participated in CNBC-TV18's macro poll on home buying said that they expect the bull run in residential real estate to continue well into the new year. In fact, 40% of the developers we polled said that they expect their own sales volumes to go up by as much as 10 to 15% in the new year. Even as 75% of these developers who participated in the poll said that they expect the mid-range sector, that's between 45 lakh to 2 crore rupees per home, to actually outperform the rest in the new year. Remember, these projections come even as luxury real estate has done rather well in 2023. But these developers say that mid-range real estate is the way to go for the new year. Now, 60% of the developers developers we spoke to said that they expect average weighted prices to go up by as much as 5 to 10% in the new year. And remember, all these projections come even as the one compelling factor that could spur home buying in 2024 being status of home ownership. At least 35% of developers who participated in the poll say so. Even as an equally significant 30% of these developers say that equity gains from the equity market bull run in 2023 could also be a factor that could spur home buying. But interestingly, the last poll or the last question on our poll raised a few eyebrows. The one big deal breaker for home buying in 2024, 75% of developers say it could well be high lending rates, thereby signaling that those much awaited repo rate cuts by the RBI could play a crucial role in just how well home buying is in the new year.
Okay, Jude, thanks a lot for that. So that's the poll on what to expect this year. But let's get people who have their ear to the ground. Samantak Das, the head of research and REIS at JLL India. Niranjan Hiranandani, the founder and managing director at the Hiranandani Group. And Irfan Razak, the chairman and managing director at Prestige Group. Join in. Gentlemen, morning to all of you. Happy New Year to you and your teams. Mr. Hiranandani, I want to start with you. You know, this sector is booming now and it's come after a very long lull period, right? The last couple of years have been good though. Do you expect this performance to continue? And if yes, what could be the big triggers in 2024? What could spur home buying?
Prime Minister Modi.
That's in 2 words, yeah, okay. But no, realistically, I mean, what are we looking at in terms of growth?
Let's be clear. Number one, the GDP growth is 6.2%. Number two, manufacturing is expired. The finance sector, BFSI sector is growing exponentially fast. The IT sector, though there has been an international recession, the extent of IT buying is still continuing in India, and that growth sector is also to be seen. The mid sector is just going exponentially high. I've never seen it so high. Even the luxury segment is growing. So that part of it is there. And the fourth point, which I see, is the infrastructure development that is taking place in the cities. Next week, on the 12th of Jan, the Prime Minister is doing the MTHL corridor in Mumbai. He's doing 2 tunnels in Mumbai, Thane Borivali Tunnel and from Shivri to Marine Drive Tunnel, which is going to be in the 2 tunnels. Of course, there's a foundation stone while he's going to cross the MTHL bridge, which is 22 kilometers round. All this and more with 300 kilometers of metro going to become operational in the Mumbai region in the next 24 months is going to see a sea change. All this and more is definitely creating boom time for real estate, not only in Mumbai. Mumbai definitely is, but also, and you know, Irfan Razak has now shifted a lot of his work in Mumbai and he's coming here to take over the markets, and congratulations to him being with us and joining us in our city. But over and above, if you see, the growth of the cities are definitely happening and India is growing, but real estate will grow faster. And I believe that the multiplier effect of real estate is going to take place in the rest of the economy. If real estate continues to grow the way it is, I'm going to see an 8% growth in GDP by the end of 2024, not the 6 and 7%.
Well, you have always been the eternal optimist, Mr. Hiranandani. Pleasure to have you on the show. And you know, that optimism is finally shaping up. Real estate is, you know, these long cycles play out. You go through a decade of a lull and, you know, this is perhaps the upswing that we are seeing. Let me bring in Mr. Razak into the conversation as well. Mr. Razak, so yeah, you know, actually tell us, because, you know, you are making inroads in Mumbai, and that's one trend that we've seen in 2023. Developers moving away from home ground to explore newer geographies. How is that playing out for you? And the bigger question, in this upcycle, where are we? I mean, they say your real estate cycles last for 10 years. So, you know, are we in the beginning, middle? Where do you think we are and how strong could the cycle continue?
Good morning, and wish all the panelists on the screen and at CNBC and all the viewers a very happy new year. Yes, the upcycle has started. It's now 3 years. I mean, just post-COVID, we've had a good run. The demand has been consistent, and we are actually producing more and more. And whatever we are producing and launching is getting taken up. And yes, we have moved to different territories, not only Mumbai. We are in most of the south, and now we have moved into Mumbai and doing not to take over, like Mr. Niranjan said. We are only there to complement and try and see how we can complement and add to the overall housing scene in Mumbai. But Mumbai also has been very good with us, and we've done well. The sales have been good. Whatever sales launches that have been done in Mumbai also, there's been a great response. Now, all this is a culmination of what I believe whichever developer has done well, who has delivered in the past and has the confidence of the buyer. Now, that's where the difference is. So there has been some consolidation, and this will continue. And we only hope and pray that the interest rates don't go up and maybe soften in a bit. That will actually increase the demand. And one point that was brought up by Mr. Hiranandani also is infrastructure. Now, it's infrastructure in all the metro cities is where we need development. If that happens, we can go further and further out and build more affordable homes. And that's the need of the day, because I always have said this, and I believe that the volumes that will come only and only from the mid-income housing, and that's where the demand is. So that's where we should focus. Yes, luxury will do well, but that's a niche market. But the actual requirement is in the mid-housing, and that's where we need to focus on.
Mr. Roy, come in. Samantha, come in on this conversation now. Do we have numbers on the extent of supply which is going to come on board in India in 2024? And if you could break that up in terms of the various metros, what would be the overall available supply which will be there this year? And how would it compare with the past years?
Hi, very good morning to all and a very happy new year. Yes, in terms of residential market, we all know, as Mr. Hiranandani and Mr. Razak, they both said about the bull run cycle. And it was a bonanza year for 2023, where we have seen 26% growth on sales from the last 2022. And in fact, let me give a slight backdrop that it's the all-time high in terms of sales in the top 7-8 cities in India. The last high was in 2010, 2 years after the GFC. It's 24-25% higher than that as well. And we believe that both in terms of launches as well as sales, we will see a good growth in 2024. The prediction of JLL Research is we will see a 10 to 15% growth on sales as well as on launches. See, the numbers of estimates, the estimated numbers vary across various organizations, but very important is the outlook is anywhere between 10 to 15% growth. Of course, we will see a lot of launches, in fact, quality launches, I will say, with prominent developers coming up in the big cities. And if you see the 2023, the tech cities really performed very well. In fact, they have crossed all other cities in terms of growth rate. And very important is in terms of sales also, if you see Bangalore has surpassed even Bombay in terms of quantum of sales, in terms of units. So the point is 2024, there are certain assumptions that we have. As the other panelists have mentioned, we are looking at some sort of a policy rate cut down to the tune of 60 to 80% on a very conservative manner, because 250 bips have gone up in terms of policy rate, and still we are seeing that the home loan is in single digit. So if another 60 to 80 bips reduction in terms of policy rate happens over the year of 2024, our belief is we will see 40 to 50 bips reduction in home loan interest rate, which actually augurs well on sales, because most of the buyers are through home loan mortgage through mortgage. So that's one.
Got
And
it.
second, of course, panelists have discussed about the growth in income, in infrastructure, and we see a lot of strategic land acquisition is happening by developers to the tune of 725 acres in the last
Sure.
1 year, which gives a very strong outlook of 81 million square feet of development potential only in residential. So
Okay.
yes,
Got
the
it, got it.
bonanza year will continue in 2024.
All right. Just before we end this discussion, right, due to paucity of time, I want to quickly take some budget expectations as well. Mr. Hiranandani, your thoughts. Is there any expectation from the budget this time?
There's a vote on account, so I don't expect anything there. But I do think that they will have to look at the affordable housing segment in order to give more incentives for the affordable segment to get a higher income tax rebate. Because what has happened with the interest rates going up and the amount of standard deduction being the same, people are not able to get that benefit. And this is one, interest rate being higher and income tax deductions being leveled at for a long time not being increased. I think the people of India would want that standard interest deduction should be increased in order to give the benefit to that. I think that should be the first demand from the Finance Minister of India. And I'm sure people would like to have houses. Housing for all is the Prime Minister's mantra. And I think we should be able to get that happen. But people can't buy the houses if the interest rates are going to be so high in the affordable segment. And that's a disaster if this sector is not being supported by the government.
Okay, all right. So we take that on board. Mr. Razak, your wish as well, and also just a word on pricing, because when we're talking about affordability, interest rates, that's one part of the equation. The other part is just market dynamics and pricing, right? And where will we be on that equation in this year?
Firstly on the budget, I like Mr. Hiranandani says, I'll ditto it. We have no expectations, but whatever he has said on the exemptions is I'll ditto that, because it's important that we give this relief to the affordable housing. And if that can be done, it'll be great. It'll spur the affordable housing more. Plus, like you said, the pricing. Now, the pricing has always been a challenge. Now, pricing is a component of land plus construction. We all know that. And looking at the developers' margins, all the listed companies work with single-digit PAT margins. So it's not that the margins are very high and then we are making a lot of money. It's not the fact. So there is, this is not something to do with budget, but GST is where some correction, if it happens, if we get the input credit, or if something can be done on GST for affordable housing, that will be a big relief for the buyers. Because today, whether you like it or not, the developer has to suffer 18% GST on its construction cost, plus the buyer pays another 5%. So straight away, there's a 23% price hike on the product, whichever product you buy, high range or mid-range or affordable. It's the same thing.
Okay, gentlemen, thanks a lot for joining in. There's, of course, this is a sector that's really booming right now. So congratulations to all of you and all the stakeholders of this sector. Hopefully 2024 will continue to be a better year, just as 2023 has been. Thanks a lot for being with us. Well, that's a sort of a discussion on real estate, which is an ongoing theme. Let's take a quick break. On the other side of the break, crude prices have been falling, so that's also positive for our markets. More focus on that in our commodity corner.
Welcome back. Well, it's been a good morning so far. The day's high was 21,750 thereabouts, and we're practically there, 10, 13 points off it. So holding steady. Let's go across to Mitesh to get some trading ideas going. Mitesh, what would you work with today?
So I'll have a buy on Berger Paints. That's a buy with a stop at about 594 and a target of around 615 on the upside. And Dalmia Bharat Cement is a buy with a stop at 2350 for targets of 2465.
Okay, all right. Thanks very much for that, Mitesh. With that, let's quickly move to commodities as well and figure out what's hot over there. We have Manisha joining in with all the action. Manisha.
Thank you for that, Surbi. Well, not so hot, and I'm talking about the metal as a sector. Well, remember, December was a very impressive rally that we saw into those markets, whether it was metal as an underlying commodity or the metal stocks. But we've started 2024 on a slightly weaker note. One, there is profit taking after that very strong gain that we saw in many of those metal prices. And then it also has to do with the dollar index, which also has seen a rebound above 102 coming back. And this is ahead of the US Fed meeting, and the market's anticipating that you could be looking at first interest rate cut within the first quarter itself. Well, if you look at the markets right now, there is some lack of clarity on timing and scale of the US rate cuts going forward in 2024. And that is perhaps what is also keeping the market slightly jittery here. As of now, we do understand that there's a 70% chance of a US Fed rate cut in March 2023. In the mid-December, it was a possibility of around 90%. So we definitely have come off from those kind of highs. Also, the kind of statements you've heard from European Central Bank and Bank of England, the officials are pushing back against premature rate cut talks right now. And that also has led to some reality check into those markets there. Fitch also has downgraded the credit ratings for 4 China state-backed asset managements, and that has led to some sell-off within China as well. In any case, the China property market, the kind of numbers that we've seen coming from China have been slightly on the weaker side. The PMI number for the month of December also came in lesser than what the street was anticipating, and there has been inconsistent government support as we've seen in sense of stimulus measures, so that continues to weigh in as well. These are the prices that we've seen in 2023 in case of metals. So nickel was an underperformer with 43% of decline. Zinc was the second worst performer with 16% of a cut. We saw decline come in for aluminum as well. So the only sole gainer in the last year was copper, up by 2.5%. But take a look at the first week of 2024, and we haven't managed to actually see a gainer here. So anywhere between 1 to 4% of a decline is what we are working with in sense of metals in the first week of this year.
Okay, thank you very much for that. On that note, we're going to slip into a very short break with the news. The sensex has reclaimed 72,000. It's a 250-point gain on that index. The nifty continues to remain steady. The first 1 hour of the market has been extremely steady, 80 points up on the nifty. On the other side of this break, Lata will get you an exclusive conversation with Manish Shokhani, Director of ENAM Holdings, to discuss his market outlook for 2024. Stay tuned.